Hello everyone, this is Tom Siomades, Chief Market Economist here at AE Wealth Management. Well, we're halfway through 2026 and it's been pretty spicy so far. Let's recap the first 6 months of the year and go over what we can expect in the months ahead as we race through this very active year. The year started off with a bang with our intervention in Venezuela, with Nicolas Maduro, a pretty unsavory character, was snatched in the middle of the night and extradited to the U.S. to face drug trafficking charges. In essence, we changed the regime in Venezuela overnight in the wee hours. The new president was more compliant and the beginnings of a new relationships began to emerge. Why is that important? Because Venezuela is a huge exporter of oil and oil sales were sanctioned due to Maduro's narco-trafficking activities. Now Venezuela can sell its oil on the open market. That's important because at the end of February, we, along with the Israelis, began a coordinated takedown of Iran's military. As expected, with 20% of the world's oil supply flowing through the Strait of Hormuz, that conflict put a severe strain on global energy prices and markets suffered significant declines. We had started the year off on a positive note, but by the end of the first quarter, the S&P 500 had lost over 4% and the NASDAQ nearly 6%. Oil ballooned to over $110, with Brent North Sea crude surging over 70% in the quarter. As we moved into the second quarter, gas prices rose to an average of over $4 for regular nationally. Inflation reared its ugly head and people began talking economic slowdown and recession. The outright bombing of Iran stopped in early April and a blockade of Iran was imposed by the U.S. Navy. The squeeze was on. How long could Iran hold out? How long could we? Iran is desperately in need of money to keep funding its regime's survival and it needs petrodollars to do that. The current Iranian government could care less about the suffering of its people. We, on the other hand, despite holding all the leverage, were concerned about the economic impact of higher oil prices on inflation and the economy. Understandably, with all that uncertainty in the region, oil tankers were reluctant to undertake the perilous voyage and oil remained elevated for most of the second quarter. Finally, as the quarter ended, a memorandum of understanding was signed between the U.S. and Iran. At least for now, that has reopened the Strait of Hormuz and both sides have agreed to negotiate their differences. That sent oil prices tumbling, but we have yet to see inflation come down or gas prices decline as quickly. That's the quick version of the major geopolitical events that drove markets, as best as I could boil it down to bare bones. I'm sure I missed details that, although news are historically worthy, were not covered, but I was looking to set a backdrop as to why markets did what they did and not give a detailed account of current events. Seldom is it the case that during a quarter or over a full year, a single theme dominates so completely. There are usually multiple themes that play out, and we did have some which we will discuss in a moment, but the elephant, as well as the 800-pound gorilla crammed into one room last quarter, was this conflict with Iran and its impact on oil markets, while everything else was subdued by comparison. Let's look at U.S. equities for a moment. Markets recouped their losses and advanced to double-digit returns in the second quarter, with the S&P 500 breaking above 7,600. We came tantalizingly close to 7,000 in the first quarter, but once the market caught wind that the worst of the Iran conflict was behind us, we blew past that level very quickly. The Dow rose to a hair below 52,000, while the NASDAQ closed above 27,000 for the first time as records were set all the way around in June. The quarter ended up with all major U.S. indices near their all-time highs. Despite the Iran crisis and oil prices dominating on a daily basis, there were also other themes that were relevant for the markets. Earnings have been stellar so far this year, and there has been some on-again, off-again rotation into and out of AI and mega-cap tech stocks. There was also all type of hype surrounding the SpaceX IPO, which seems to have cooled somewhat. Drama with the Fed as Kevin Warsh replaced Jerome Powell as chair, and a shift in policies were some of the other U.S. market drivers in the first half. International markets have not done as well as the U.S. in the first half, with the notable exception of Japan, which is up nearly 40% so far this year, with the Nikkei 225 surpassing 70,000. Much of that has been driven by the AI and semiconductor boom and pro-growth policies from Prime Minister Sanae Takaichi. As for the European and the rest of the Asian markets, both were hurt by higher energy costs as they lagged the U.S. On the fixed income side, the U.S. 10-year note, which was yielding 4.15% at year-end, spiked by over half a point in May as the Iran crisis dragged on without a deal, and it was becoming apparent that inflation had arrived and it was not going to be the quick blip we were promised once the conflict ended and oil prices plummeted. The other development was the outlook for rate cuts. Markets were banking on one or two cuts in the second half of 2026. As the Iran conflict unfolded and the price of oil shot upward, we began to see and feel inflation, especially at the gas pump. The conversation then shifted from rate cuts to the hope that rates would remain the same the rest of the year. Still, fears of outright hikes in order to keep inflation in check began to creep into the conversation and to scare markets. Jerome Powell's term as chairman ended in May, and President Trump appointed Kevin Warsh as the new Fed chair after some drama in Congress. Warsh chaired his initial Fed meeting in June, which highlighted the shift in thinking at the Fed. Rates remained unchanged, but there were numerous voices which will quickly grow if inflation continues to rise, calling for an actual hike. The ironic thing is that Warsh was brought in because Trump wanted rates cut. At this rate, it appears more likely we may see a rate hike before we see a cut. Internationally, rates across the board were mostly lower than their U.S. counterparts, with the exception of the U.K. Then again, the rest of the world has always been much more tolerant of higher prices than we are. Economic growth has been slow, but it's hard to judge given all the turmoil we have seen since the government shutdown late last year. GDP is running at around 2%, a far cry of over 4% annual growth we were promised by the Trump administration earlier this year. In fairness, the economy has been far from normal, starting with Liberation Day when tariffs were first announced, all the way to the most recent conflict with Iran. That's not to say the economy is bad, but I wouldn't say it's good either. The economy appears to be just there. The first quarter, 2.1% GDP growth confirms that. But there's always seems to be a disclaimer about why it's so low. Once we get through the tariffs, once the government reopens, once the Iranian crisis is over, once oil prices come back down, you get the idea. It's always something, but once we get past the latest one-off, we will enter the golden age. Hey, once again, 2% is not 4%, and I was not a math major. Overall, turbulent and chaotic so far, but we have come to expect that recently. I did say at the end of the year that I was not expecting 2026 to be calm, and so far it hasn't been. Let's talk about the final half of the year and what we may expect. I do not think this thing with Iran is over. This regime has not lived up to any promises it has made in nearly 50 years, except in exporting terror around the world. I think we'll be back to hostilities sooner than later when it comes to Iran. I still expect GDP to perk up, but maybe not at a 4% pace. The Atlanta Fed GDP Now model is forecasting plus 3% for the second quarter. We'll see how close we get to that. Earnings will also be good, so that will not be a headwind for the market. The big unknown will be where inflation and gas prices go in the weeks and months ahead. If inflation gets much worse, the Fed will raise rates and markets will not be happy. Midterm elections will dominate the end of the third quarter and the first half of the fourth quarter. Midterms are generally bad for incumbents, and in this upcoming election, the issue that will be center stage is affordability. If inflation keeps rising and gas prices stay high, all summer long, it will be hard for Republicans to retain control. Yet split government is not always a bad thing. As I have said before, a divided government is best for markets because that means that there are less big things coming from Washington for markets to navigate around and less bad ideas from people who are not good at managing budgets and money. Politicians will spend their time fighting each other and leave the rest of us alone, one would hope. I know it's easy to lose sight of where things stand given the frenetic news cycle and the constant bombardment of information being thrown at you, and the feeling that you need to act. Take a deep breath, be thankful for what you have and not about what you do not have. Also remember to remind yourself that you have a plan and a team behind that plan that will help you execute on it. Be patient and do not give in to emotion. I will be back with you in 3 months and we could look back on the third quarter to get another check on our progress, to see how we're tracking so far and how clear our crystal ball really was. It is never a bad idea to review your goals with your advisor and make sure you're on schedule and possibly rebalance back to a risk tolerance you're comfortable with. A halftime review is never a bad thing for this exercise and will leave you with a sense of calm that your plan is up to date and you have included all the recent and relevant information, if you need to make any new decisions and adjustments. I believe 2026 will continue to be strong and will be a good year for markets. But as always, there will be challenges, some expected, others not. We'll see how close we're tracking and how close our estimates are of the markets and the economy, and if we need to consider any new developments in the months ahead. There will always be something new we will have to factor in. I hope everyone has a fantastic summer with their family and friends. Be responsible, and more importantly, please be safe. Reach out if you have any questions. Thank you.